Hello, everyone. Today, markets are showing a clear relief tone at first glance. Wall Street is higher, European equities are strong, oil prices are falling, and investor confidence appears to be improving. But inside this picture, there is a very important distinction. Equities are telling us one story, oil is telling us another, gold is still undecided, euro/dollar remains trapped in a technical range, and the S&P 500 continues to hold strong near its highs. So the real question today is not simply whether markets moved higher. The real question is this: are we seeing a durable return of risk appetite or just a short-term relief move driven by geopolitical headlines? Today, as of Monday, June 15th, 2026, we will go through the technical outlook for euro/dollar, gold, the S&P 500, and WTI crude oil within that framework. Let's start with the big picture. Wall Street extended its gains on Friday as hopes for a diplomatic solution that could end the Iran war continued to pressure oil prices lower and support investor confidence. In the United States, the S&P 500 rose 0.5%, the Nasdaq 100 gained 0.6%, the Dow Jones Industrial Average advanced 0.7%. The MSCI World Index, which tracks global equities, rose 0.9%. One of the key headlines of the day was SpaceX. After its historic IPO, the stock jumped 19%. The company's market value reached 2.1 trillion US dollars, while Elon Musk became the world's first trillionaire. On the oil side, the main story was diplomacy. United States crude oil fell below 85 US dollars per barrel after Washington indicated that a temporary peace agreement, one that would reopen the Strait of Hormuz and end Iran's nuclear objectives, was becoming increasingly likely. A senior administration official placed the probability of an agreement at 80 to 85%. However, markets briefly turned volatile after President Donald Trump claimed that Iran had leaked the terms of the deal. The sharp decline in oil prices also reduced concerns about inflationary pressure. As a result, investors pushed expectations for the next Federal Reserve rate move into next year. Friday's data also supported this softer inflation narrative. United States consumer confidence rose in early June for the first time in 4 months, helped by lower gasoline prices. On the company side, Adobe declined after its chief financial officer announced plans to leave. Roku gained on reports that it may be exploring a potential sale. ExxonMobil also came into focus on speculation that it may be evaluating acquisition targets, including Australia-based Woodside Energy. Europe also delivered a strong session. The Stoxx Europe 600 rose 1.9% and ended the week in positive territory, supported by the pullback in oil prices. Travel stocks were among the strongest performers. As fuel costs declined, the airline index reached its highest level since the start of the Iran war. International Airlines Group rose 7.1%, while Accor gained 5.6%. United Kingdom home builders also recovered from levels last seen in 2012 after money markets reduced expectations for further Bank of England rate hikes. The banking sector was also strong. The sector index rose 4.2%. A possible bidding war around Banca Monte dei Paschi di Siena supported Italian financial stocks in particular. Deutsche Bank, Barclays, and Societe Generale led the move higher. Telecommunications stocks also stood out. Nokia jumped 10.1% after JP Morgan said the company could comfortably exceed its 2028 profitability targets. Basic resources and construction stocks joined the rally as well. In construction, Acciona rose 10.4% on reports of possible bids for its energy unit. But again, there was a clear sector divergence. Energy was the weakest sector because peace hopes pushed oil and gas prices lower. Repsol and Vår Energy were among the biggest decliners. Shell fell after pausing its share buyback program to finance the ARC Resources acquisition. BP also declined after reports that it may consider selling stakes in 2 Gulf of Mexico projects. So the message is clear. Risk appetite improved, but energy stocks were pressured by the same oil price decline that supported the broader market. Now let's move to commodities and currencies. Crude oil prices continued to fall as the number of vessels passing through the Strait of Hormuz kept increasing, reinforcing peace expectations. WTI crude oil fell 3.8% and closed at 84.35 US dollars per barrel. Brent crude dropped more than 3% to 87.33 US dollars. Brent is now trading roughly 30% below its war period peak. European natural gas prices fell as much as 8% during the session. Spot gold was broadly flat after a calmer trading day. In currencies, the Bloomberg Dollar Spot Index was generally unchanged. The euro was little changed at 1.1571 US dollars. Sterling held at 1.3409 US dollars. The Japanese yen weakened 0.2% against the dollar to 160.20. In bonds, the United States 10-year Treasury yield rose 2 basis points to 4.48%. Germany's 10-year yield fell 4 basis points to 3.00%. The United Kingdom 10-year yield declined 7 basis points to 4.84%. In crypto, Bitcoin rose 0.5%, while Ether fell 0.2%. A quick note here, the index, commodity, and currency tables provided by TradingView may be based on futures and / or CFD pricing, so they can differ slightly from spot prices. For today's economic calendar, the United States Empire Manufacturing Index is scheduled at 2230, followed by monthly industrial production at 2315. Let's begin the technical section with euro/dollar. On the daily chart, the outlook is neutral. Euro/dollar is trading around 1.16067 in a technically uncertain position. The price is trapped between tightly clustered moving averages, which are giving conflicting directional signals. The 14-day moving average is at 1.15922, just below the current price. This level is acting as immediate dynamic support. But above the market, the resistance area is much more important. The 50-day moving average is at 1.16726. The 200-day moving average is at 1.16769. These two long-term references are almost perfectly aligned. That means the 1.1672 to 1.1677 region is a very strong resistance cluster on the daily chart. The fact that the price fell back below both the 50-day and 200-day moving averages after the latest recovery attempt suggests that the previous bullish momentum has been largely reversed. In the broader structure, euro/dollar has generally traded between 1.1400 and 1.2000 since July 2025. That confirms a range-bound market rather than a clear trend. The SMI indicator supports this neutral but slightly weak picture. The fast line is at -25.21, while the signal line is at -36.66. It is not in oversold territory, but it remains negative and points to mild downside momentum on the daily time frame. For investors, 1.15720 is the key short-term support. A break below that level would bring the 1.1500 psychological support into focus. On the upside, the 1.16726 to 1.16769 zone is the main resistance area. Moves toward that region may face selling pressure. A move above 1.1700 would weaken the bearish interpretation and should be watched carefully from a risk management perspective. The 4-hour chart gives a more constructive short-term signal. Here, the outlook is bullish. The key feature is the clear momentum divergence between price and the SMI indicator. While the price made a new multi-week low near 1.1560 in early June, the SMI fast line climbed strongly to 66.03 and the signal line rose to 59.54. That is a classic bullish divergence. In simple terms, price made a lower low, but momentum recovered sharply. That suggests that selling pressure may have been exhausted near the lows and that buyers started absorbing supply. However, there is still one important test for the bulls. The price is around 1.16065 and remains below the 200-period moving average at 1.16486. This level is the main dynamic resistance on the 4-hour chart. Below the market, the 50-period moving average is at 1.15681 and the 14-period moving average is at 1.15629. Both have been broken to the upside and have now turned into short-term support. So the critical level is 1.16486. A 4-hour close above this level would signal a stronger recovery and could bring 1.1700 into focus. But there is also a short-term caution. The SMI is already in overbought territory at 66.03, which increases the risk of a pause or pullback. In that case, the 1.15681 area may offer a higher probability support zone. A move below 1.15629 would invalidate the bullish divergence scenario. Now let's move to gold. On the daily chart, gold also has a neutral outlook. The price has corrected significantly from its all-time high around 5,500 and is currently trading at 4,296. The key issue is that gold has now moved below its important moving averages, which have turned into dynamic resistance. The 14-day moving average is at 4,363 and sits above the current price. It is acting as the first upper band. The 50-day moving average is at 4,450 and has started to flatten. This level is also converging with the 200-day moving average. That makes the 4,450 to 4,580 region the most important technical barrier for gold if it wants to rebuild an upside trend. The fact that the price is below all major moving averages confirms broad weakness across short-term, medium-term, and long-term momentum. The SMI indicator is at minus 38.22 on the signal line and minus 49.74 on the fast line. It is approaching oversold territory, but it has not yet produced a clear exhaustion signal. This means downside momentum may still continue. The intraday rebound of 1.83% looks, at this stage, more like a relief rally within a weakening structure than a confirmed trend reversal. For gold, the 4,363 to 4,450 region stands out as a potential resistance and selling area. A break below 4,246 would increase the risk of a move toward the 4,000 psychological level. Sustained price action above 4,450 would weaken the bearish scenario. The 4-hour chart for gold is more constructive. Here again, the key point is the strong momentum divergence between price and the SMI. While the price recently formed a multi-month low near 4,165, the SMI fast line rose to 66.77 and the signal line climbed to 52.53. That is a classic bullish divergence. Price made a lower low, but momentum recovered strongly. This suggests that selling pressure may have been exhausted near the lows. The 14-period moving average is at 4,165 and overlaps with the recent low, making it a critical short-term support. The 50-period moving average is at 4,307, which is the first important resistance. The 200-period moving average is at 4,512 and stands as the main structural resistance in the broader 4-hour picture. The current price is 4,296, very close to the 4,307 resistance. So the reaction around 4,307 will be important. A 4-hour close above 4,307 could open the way toward 4,450 and then 4,512. On pullbacks, the 4,246 area may act as a renewed support zone. A break below 4,165 would invalidate the bullish divergence scenario. Now let's look at one of the strongest charts in today's setup, the S&P 500. On the daily chart, the outlook is clearly bullish. The index has recovered strongly from the sharp April low around 6,350 and has returned to the all-time high area. The price is currently at 7,502.78 after closing the session up 0.96%. It is trading very close to the session high of 7,507.65. Technically, all key moving averages remain below the price. The 14-day moving average is at 7,480.47 and provides short-term dynamic support. The 50-day moving average is at 7,282.35 and acts as a deeper structural support. The 200-day moving average is at 6,898.64 and continues to slope upward, confirming that the main macro uptrend remains intact. This structure tells us that the April decline is currently being treated as a correction, not a trend reversal. The SMI indicator is at minus 6.49 on the fast line and minus 16.80 on the signal line. The important point is that the indicator has cooled down from overbought levels while the price has moved back toward new highs. This does not create a bearish divergence. Instead, it suggests that momentum has reset without breaking the trend. So 7,507 is the key short-term resistance. Sustained price action above this area would confirm the new high structure and bring 7,750 into focus. On the downside, 7,480 is the first support. 7,282 is the main risk level on the daily chart. The 4-hour chart also supports the bullish daily view. The price is around 7,502.65 and trades above all major moving averages. The 14-period moving average is at 7,371.32. The 50-period moving average is at 7,444.67. The 200-period moving average is at 7,410.10. This alignment shows that bulls remain in control in the short term. The 50-period and 200-period moving averages are clustered between 7,410 and 7,444. This area absorbed the previous correction and now acts as an important support band. The SMI indicator is in overbought territory, with the fast line at 75.30 and the signal line at 65.94. This confirms strong momentum, but also increases the probability of short-term consolidation. However, there is no bearish divergence. The indicator is still moving in line with price, which confirms that the short-term trend remains technically healthy. The 7,410 to 7,444 zone is the main short-term support area. Pullbacks into this region may be viewed as potential buying opportunities within the existing uptrend. The upside target is 7,600. A move below 7,371 would weaken the short-term bullish structure and should trigger tighter risk management. Now let's move to the most important divergence in today's market: WTI crude oil. On the daily chart, WTI is clearly bearish. The price closed at 81.499, down sharply by 4.44%, and broke below the important horizontal support around 82.00. That level had previously acted as a structural floor. This break confirms a clear deterioration in the trend structure. All key moving averages are now above the price. The 14-day moving average is at 91.34. The 50-day moving average is at 97.33. The 200-day moving average is at 74.18. This creates a layered resistance structure above the market. The downtrend that started from the April peak around 115 remains in place. The 200-day moving average at 74.18 is now the key long-term support below the market. If WTI breaks below 80.955, a new leg lower towards 74.18 could come into play. The SMI indicator is deeply negative. The fast line is at minus 77.054 and the signal line is at minus 70.057. It is approaching deep oversold territory. That could increase the probability of a short-term technical rebound. But the key point is that there is still no bullish divergence. Momentum is moving lower together with price. So any rebound toward 91.3, 4 or 97.33 may still face selling pressure within the broader downtrend. A daily close above 91.34 would weaken the bearish structure. The 4-hour chart confirms the bearish daily view. The price is around 81.232 and trades well below all major moving averages. The 14-period moving average is at 88.235. The 50-period moving average is at 92.256. The 200-period moving average is at 98.237. This is a clear bearish stack. Since April, the market has formed lower highs and lower lows. The break of the 85.00 region in June accelerated the downtrend. The SMI indicator is also in oversold territory. The fast line is at minus 75.427 and the signal line is at minus 68.640. Again, this raises the possibility of a short-term technical bounce, but there is no divergence. Momentum is not weakening yet. It is only stretched, so rebounds should still be treated as counter-trend moves. The first strong resistance is 88.24. The main selling area is 92.26. On the downside, a break below 80.955 would bring 78.00 into focus first, followed by the 74.00 to 74.18 region. A 4-hour close above 88.24 would weaken the short-term bearish setup. Let's simplify today's picture. On the equity side, risk appetite is strong. The S&P 500 remains bullish on both the daily and 4-hour charts. On the oil side, the picture is the opposite. WTI crude oil is bearish on both timeframes. Diplomatic hopes are pushing oil prices lower, and that also supports the idea of reduced inflation pressure. Gold and euro/dollar are more complex. On the daily charts, both are neutral and undecided. But on the 4-hour charts, both show bullish divergence. That means short-term rebound potential exists, but broader confirmation has not arrived yet. So the main message today is this: markets are pricing optimism, but that optimism is not equally strong across all asset classes. The S&P 500 is strong, oil is weak. Gold and euro/dollar are still looking for confirmation. As we enter the new week, the key levels to watch are for euro/dollar, 1.16486 and 1.16726 are resistance levels, while 1.15720 is key support. For gold, 4,307 and 4,450 are resistance levels, while 4,246 and 4,165 are support levels. For the S&P 500, 7,507 and 7,600 are the main resistance levels, while the 7,410 to 7,444 zone is the key support area. For WTI crude oil, 88.24 and 92.26 are resistance levels, while 80.955 and 74.18 are the key supports. If you found this video useful, please like it, subscribe to the channel, and write in the comments which asset you are watching most closely right now. Is it euro/dollar, gold, the S&P 500, or WTI crude oil? You can also share the key levels you are watching in the comments. See you in the next video.